Shadow banking, the $200 trillion debt you never hear about. Picture this. You wake up one morning, check the news, and see the words liquidity stress, funding squeeze, central bank intervention, markets stabilized after emergency action. And you think, ah yes, one more normal Tuesday in the enchanted forest of modern finance. But here's the part nobody tells regular people. Some of the most dangerous money in the world is not sitting in your neighborhood bank. It lives in money market funds, hedge funds, broker-dealers, repo markets, securitization chains, structured vehicles, and giant pools of collateral moving around the globe at high speed. Officials now usually call this world non-bank financial intermediation, or NBFI, which is basically the cleaned-up, professional way of saying shadow banking. The Financial Stability Board says NBFI assets reached $256.8 trillion at the end of 2024, or 51% of global financial assets. Even the narrower slice most associated with bank-like vulnerabilities reached $76.3 trillion. So when someone says the shadow banking system is over $200 trillion, they are not talking about a conspiracy bunker under Switzerland with man in capes counting gold bars. They are talking about a gigantic financial ecosystem doing bank-like things outside traditional banks. The FSB has long defined shadow banking broadly as credit intermediation involving entities and activities outside the regular banking system. And once you understand that, the whole financial world starts looking less like a fortress and more like a very expensive Jenga tower lubricated with leverage. What shadow banking actually is? Let's clear something up. Shadow banking does not mean illegal banking. It does not automatically mean secret banking, and it does not mean every non-bank institution is evil. What it means is simple. These are institutions and activities that perform bank-like functions: lending, maturity transformation, liquidity transformation, collateralized funding, but they are not traditional deposit-taking banks. Classic descriptions from the New York Fed explain that shadow banks use things like securitization and secured funding, including asset-based commercial paper, repo, and similar wholesale funding structures. A normal bank takes deposits, makes loans, and has access to public backstops like deposit insurance and central bank liquidity. The shadow system does something similar, but instead of grandma's savings account, it often relies on short-term wholesale funding, collateral chains, institutional cash pools, fund shares redeemable on demand, and markets that work beautifully right up until everybody wants out at once. The FSB's narrow measure focuses specifically on NBFI activities with funding models vulnerable to run risk, leverage, or short-term wholesale funding dependence. So the old financial world said, "Bring me your deposits." The new financial world says, "Bring me your collateral, your pension assets, your treasury bills, your yield-hungry capital, your overnight cash, and your emotional support spreadsheet." How the shadow system creates money-like things. This is where the rabbit hole opens. Traditional banks create money mainly through lending. Shadow banking creates money-like claims. In the classic shadow banking model described by the New York Fed, risky long-term loans can be transformed through securitization and wholesale funding into short-term instruments that investors treat as safe and cash-like. In plain English, ugly assets go into the machine, polished, safe paper comes out, and everyone pretends the machine can never jam. One of the core gears in this machine is the repo market. A repo is basically a short-term collateralized loan. Here, take this security, give me cash now, and I'll buy it back very soon. The BIS has described repo markets as playing a prominent role in shadow banking, and researchers have long emphasized how central secured funding is to the whole system. Another major piece is the money market fund.
These funds are often treated by investors as near-cash parking lots, but regulators have repeatedly warned they can be vulnerable to runs. The SEC's reforms and FSB reviews both highlight the structural run risk in money market funds, especially during stress. Then add hedge funds, broker-dealers, finance companies, structured finance vehicles, securities lenders, and giant investment funds. By the end of 2024, the FSB reported roughly $12.1 trillion in money market funds, $11.3 trillion in hedge funds, $12.7 trillion in broker-dealers, $7.5 trillion in finance companies, and $6.5 trillion in structured finance vehicles inside the monitored global NBFI universe. So yes, there is a reason this world feels slippery. Your bank account is simple. This system is like if a loan married a bond, had a baby with a derivative, and asked a money market fund to babysit. Why the shadow system became so huge? Now here comes the twist. Shadow banking did not explode because finance people got bored and wanted new acronyms. Well, not only because of that. It grew because the world wanted more credit, more liquidity, more tradable assets, and more yield than the traditional banking system alone could comfortably provide. The FSB notes that non-bank finance can support real economic activity and diversify credit supply, while the IMF has emphasized that non-banks now account for around half of global financial assets. And after the 2008 crisis, regulators tightened rules on banks. That made banks safer in many ways, but it also encouraged more financial intermediation to migrate outside the traditional banking perimeter. Recent IMF work explicitly notes that NBFIs have grown during periods of intensified regulatory pressure on banks. By the end of 2023, the FSB put the NBFI sector at $238.8 trillion, or 49.1% of global financial assets. By the end of 2024, it had risen to $256.8 trillion, or 51.0%. That is no side alley of finance anymore. That is the city. And here's the punchline most people miss. Banks are still deeply connected to this world. The FSB's 2025 monitoring report says banks still dominate loan assets, but the NBFI sector holds 61.4% of all debt securities. In other words, a huge share of modern credit markets now sits in institutions that are not ordinary banks, even though stress can still come roaring back into the banking system. So if you thought real finance happens in banks, while weird finance happens on the side, modern markets would like to laugh respectfully in derivatives. Why it can break so violently? The problem with shadow banking is not that it works. The problem is that it works beautifully until confidence evaporates. Because a lot of this system depends on short-term funding, redeemable claims, leverage, and collateral values, it can suffer bank run-like dynamics without looking like a classic bank run. The FSB's narrow measure specifically targets activities with liquidity or maturity transformation and leverage because those are the ingredients that turn stress into panic. We saw this in the March 2020 dash for cash. The FSB's review says non-government money market funds experienced significant outflows, open-ended funds saw redemptions, and strains hit core funding markets as everyone wanted dollars and dealers' capacity was limited. We saw another version in the UK gilt turmoil of 2022. The Bank of England and bank staff later described how highly leveraged liability-driven investment strategies amplified the stress, forcing margin calls and emergency intervention. One Bank of England paper put it bluntly, highly leveraged LDI strategies were identified as an amplifier of the crisis. And notice the pattern. The system says it is market-based, private, and efficient during the boom, then develops a sudden spiritual conviction that the central bank must appear immediately when margin calls start flying around like flaming pigeons. That's the secret biography of shadow banking. Private upside, public panic button. Why central banks keep getting dragged back in. Here's one of the most important points in the whole story. Shadow banking often grows because it operates with less direct protection than banks. But when it gets stressed, authorities step in anyway because the system is too interconnected to ignore. That happened in 2008, it happened in 2020, and in the UK after the gilt turmoil of 2022, the Bank of England later created a contingent non-bank financial institution repo facility designed to address severe gilt market dysfunction arising from sudden liquidity needs among non-banks. That is an astonishing sentence if you stop and think about it. The shadow system got big enough that a central bank built a tool specifically for non-banks needing liquidity against
Collateral. Why? Because modern finance is deeply entangled. The IMF warned in 2025 and 2026 that growing non-bank importance increases interconnectedness and can amplify shocks, while the Fed has also examined how bank funding of NBFIs can become a channel of liquidity stress under stress. So the fairy tale that shadow banking is somehow outside the system is nonsense. It is not outside the system. It is the system. It just rents a different costume. Why this matters to normal people. At this point, some viewers are thinking, okay, cool nightmare, but I don't run a hedge fund. Why should I care? Because when this machine seizes up, it does not stay on Wall Street. When wholesale funding markets freeze, borrowing costs can jump. When big funds dump assets to meet redemptions or margin calls, prices can gap down fast. When markets break, central banks intervene, governments adjust policy, and eventually the consequences filter outward through pensions, credit conditions, asset prices, jobs, business financing, and household wealth. That is exactly why global regulators spend so much time monitoring NBFI vulnerabilities rather than dismissing them as somebody else's casino. Also, many ordinary people are already in this system without realizing it. Their retirement funds own bonds through giant asset managers. Their cash may be parked in money market products. Their mortgage may be securitized. Their employer may depend on market-based funding conditions. Their safe portfolio may be one liquidity mismatch away from a very educational week. Finance has a wicked sense of humor. It will tell you something is diversified, resilient, and liquid, and then, during a crisis, reveal that half the room was using the same exit. The big reveal. So what is the real story here? The real story is not merely that shadow banking is large. It is that the financial world quietly rebuilt bank-like fragility in forms that look more sophisticated, more distributed, and more market-based. And to be fair, some of that system is useful. Non-bank finance can broaden credit access, deepen capital markets, and give savers and borrowers more options. Regulators themselves say that non-bank finance has real benefits, but scale changes the meaning of everything. At $256.8 trillion, this is no longer a niche side quest for finance nerds. And when the FSB says the more vulnerability-prone narrow measure is $76.3 trillion, that means a vast amount of modern finance still depends on structures vulnerable to runs, leverage shocks, or liquidity stress. That is why the title matters. Shadow banking, the $200 trillion debt you never hear about. Because most people are taught to fear government debt, credit card debt, or mortgage debt. But the deeper machinery of the global system lives in collateral chains, wholesale markets, fund structures, repo books, and non-bank balance sheets so huge they make ordinary conversation tap out and go lie down. And once you see that,
every unexpected financial rescue starts looking a lot less unexpected.